If you're a teenager in the UK who wants to start investing, but you're not sure where to begin, this video is going to save you hours of confusion. I'm Zane, I'm 18, and over the past year I built a portfolio of £3,000 from scratch. In this video I'll show you exactly how to start investing the easy way, step by step, even if you've never bought a stock before. Everything in this video isn't financial advice, and you should always do your research when researching stocks. Before I get into the steps, here's why starting early matters so much. Even small amounts invested as a teen can grow massively because of compound interest. £100 a month from 18 could grow over £200,000 by retirement without ever increasing your contributions. The earlier you start, the easier it gets. On screen you can see I'm setting up a compound interest calculator. This is at £100 a month at 7% interest from 18 to 65, and that gives you a calculation of £410,000. Obviously 7% is a calculation used from the S&P 500, which averages 10% yearly, but it's 7% after inflation. Clearly you can see here that even at just £100 a month you can make a lot of money. This is based on past returns, so obviously this isn't an indication of what could happen in the future, but when you look at it, it's definitely hard to argue with the returns as it gets. You can always obviously add more than £100 as well, which could increase this by substantially. Now you've got to learn the basics before you put any money in and understand what you're investing in. ETFs are bundles of stocks. The S&P 500 is the top 500 companies in the US. You have, and this is an index fund, the VUSA, as well as the EQGB, which tracks the Nasdaq 100, the top 100 tech companies in the US. You also have individual stocks such as Nvidia, which obviously has done incredibly well this year, and then also Microsoft. These are always seen as riskier because it's one company. If something bad happens, you could lose all your money. ETFs are seen as a lot safer due to the fact that they can always swap and change what companies are in there, so that it's always balanced and it's always hopefully improving. Obviously individual stocks can perform a lot better than ETF because it's one company, but that also increases the risk significantly. It's completely individual on what people want to do and their risk tolerance and such. The next step, we need to pick a platform. There's lots of them out there, and in the UK the easiest way to do this is through a stocks and shares ISA. You have companies like Vanguard which offer their own funds, but Vanguard does charge extra as a management fund as well as your currency exchange and such. So my favourite one to use is Trading 212, which I'll show you on the screen in a second. They have zero commission and no tax on your gains. The only fees you pay are stamp duty in the UK, which you have to do on anything, as well as currency exchange if you were to buy an American stock in dollars as such. But anything in the UK, you pay only stamp duty. You also can earn 4% interest on your money that you leave in there, and I see it as the best platform to be using. I've used it now since April and I absolutely love it. You also have places like Invest Engine. This isn't one I can say I've used, but I know a lot of people do, and so if you're looking to go for another one, I can't recommend it, but it's always good to research and find the best one that suits you. If you're under 18 and you want to learn, you can start learning through a parent's account or paper trading. The key though is understanding how it all works early on. You don't need thousands to start. That's a big myth that's told to keep people from investing. Even £10 to £20 a week can make a huge difference. Trading 212 has automatic deposits, and if you deposit that into an ETF, you'll just forget about it. My favourite expression is always, time in the market will always beat timing the market. Even if you're at all-time highs, it's still a good time to invest, even with ETFs, just because of the fact they're so stable and they give such good returns. The S&P 500 returns 10% year on year annually on average. Now obviously that is on average, so it does change from some years, but it's incredibly stable and it gives good returns. There's a reason so many people invest into it. The hardest part about investing, it's not starting, but it's sticking with it. It can seem sometimes like it's not worth it, especially if you do lose some money at points. But the markets go up and they go down. If you just invest monthly, set up automatic deposits, and just forget about it, you'll come out a lot further ahead than most other people will. Market dips happen, but it's how you react to them that's more important. Don't panic though. Look at what's happening. Remember April, when there's all the big crash? People put so much more money in because they knew it would rise back up. That's why an ETF is always going to be a good safe bet. So, to recap, you need to learn the basics, pick a good, stable platform that is easy to use and you can understand quickly. Start small, £10 to £20 a week is all you need to do. And then stay consistent. Consistency is the key in the stock market. Nothing else matters. That's all you need to begin investing as a teen in the UK. I'll keep sharing my progress as I grow my £3,000 portfolio, so subscribe if you want to follow along and learn as I go. Hit subscribe and join me on the journey to financial freedom. Thanks for watching, and I'll see you in the next one.